Here's something that might surprise you. Warren Buffett doesn't chase hot stocks or cryptocurrencies. Instead, he built his wealth using a simple dividend strategy that most investors over 50 often ignore. His company, Berkshire Hathaway, now makes over $700 million every year just from Coca-Cola dividends, coming from a single investment he made back in the late 1980s. The stock didn't need to triple in price to make him rich, it was the steady growth of dividends year after year that did the job. You might be thinking, that's great for Buffett, but I'm not a billionaire. The truth is, his approach works whether you're starting with $5,000 or $5 million, the strategy doesn't change. Most men our age make a big mistake, they go after companies with high dividend yields, like 8% or 10%, thinking it's a shortcut to easy money. But those high yields often come with high risks, and they're the reason many people never build real wealth. Today, I'm going to walk you through Buffett's actual strategy, the same one that turns small investments into huge streams of income. You'll see how it's possible to grow $5,000 into $200,000 in yearly dividend income. Sounds crazy? Let me break down the math for you. The first and most important shift: stop chasing high yields. Start looking for companies with strong dividend growth. Most investors over 50 make the same mistake right away, they sort stocks by dividend yield and grab anything offering more than 5%. When you're nearing retirement, high yield looks tempting. But here's what Warren Buffett understood that most people miss: high yield usually means high risk. If a company is paying 8% or 9%, ask yourself why. Most of the time, it's because their stock price crashed due to weak business performance, and now they're borrowing money just to keep paying dividends. In a recession, those dividends are the first thing to get cut. My neighbor Jim in Texas made this mistake. 2 years ago, he was proud of his 8% dividend portfolio full of REITs and energy stocks that seemed solid. But then the market dropped, and 3 of his biggest investments slashed dividends by 30% to 50%, turning his safe income into a painful loss. Buffett took a different path. When he bought Coca-Cola stock back in the late 1980s, it didn't have a huge yield, but the company kept increasing its dividend every year, now for more than 60 years. Thanks to that steady growth, Buffett earns more than 50% per year on his original investment, meaning he gets 50 cents in dividends every year for every dollar he originally put in. In 2023 alone, Coca-Cola paid Berkshire over $700 million in dividends. Not because it had a high yield at the start, but because it was a strong, reliable business that kept growing. That's the power of dividend growth, and that's the kind of stock you want to own. Stop sorting stocks by yield. Instead, look for companies that have increased their dividends every year for at least 10 years. These are called dividend champions, 10 to 24 years of growth, or aristocrats, 25+ years. Use sites like Dividend.com or Seeking Alpha to find companies with 5 to 7% average annual dividend growth over the past 5 years. Also, check the payout ratio, how much of earnings are paid as dividends, and keep it under 75% to ensure the company has room to keep growing. The most important test comes from Warren Buffett himself: would you want to own the whole business? Look for strong brands, a competitive edge, called a moat, and steady profits. And if you can't explain what the company does to your spouse in under a minute, don't buy it. You're not just buying a dividend, you're buying a business that pays you regularly. Next step, build your core just like Buffett did. Many people think owning 40 dividend stocks spreads risk, but Buffett disagrees. He says too much diversification protects people who don't know what they're doing. His billions in dividend income come from just 5 companies: Coca-Cola, Apple, Chevron, Bank of America, and American Express. That's it, 5 companies, not 50. If you're over 50, you need businesses you deeply understand and trust to be around for 20 more years. Here's what to look for: at least 10 years of growing dividends to show solid leadership, payout ratios between 40% and 75% so there's money left to grow the business, strong and consistent cash flow, because dividends aren't magic, they need real profits, and clear economic advantages like a trusted brand, massive scale, or a loyal customer base that keeps competitors away. Here are 5 great examples that match Buffett's rules. Coca-Cola has raised its dividend for 62 years and is known all over the world. People keep buying it even during tough times. Johnson & Johnson, also with 62 years of growth, is a healthcare giant with everyday products and strong research. PepsiCo has increased dividends for 52 years and has both drinks and snacks, making it more stable than just a beverage company. Procter & Gamble owns big-name products like Tide, Gillette, and Pampers, things people buy no matter what the economy looks like, and it has 67 years of dividend increases. Chevron has grown its dividend for 37 years, and Buffett recently bought more of it because it returns capital to shareholders consistently. What do these companies have in common? They're all part of your daily life. You understand what they do, and you can see them making money for decades to come. That's Buffett's style: own companies that last. To spread out your risk, choose one solid business in each sector. For example, Coca-Cola in consumer goods, Johnson & Johnson in healthcare, Chevron in energy, Microsoft in technology, and JP Morgan Chase in finance. With just 5 strong companies, you can focus your research and really understand where your money is going. Keep an eye on company results every quarter and track how their dividends grow over time. When the market gets rough, this will help you stay confident and avoid panic selling. Is this clicking for you? If so, drop a mind blown emoji because what you're learning here can change everything. Now, the third smart move: master the reinvestment snowball. This is where the real magic happens, and most investors miss it completely. Taking dividend payments as cash might feel good in the moment, but reinvesting them automatically creates a compounding effect that can turn even small investments into big income over time. Here's how it works. Say you buy 50 shares of Johnson & Johnson at $160 each, which totals $8,000. J&J pays about $4.76 per share annually, so in the first year, you earn $238 in dividends. Instead of taking that in cash, you use it to buy 1.5 more shares. The next year, your dividends are based on 51.5 shares instead of 50. Each year, those extra dividends buy you even more shares. After 10 years, without putting in another dollar, you could end up with 65 or 70 shares. And here's the best part: J&J doesn't just keep the dividend the same, they raise it almost every year. So you're earning dividends on more shares each year, and each share is paying more. That's how the snowball grows. Buffett's original investment in Coca-Cola shows the power of double compounding. The company keeps increasing its dividend every year, so Buffett's income grows even without buying more shares. Meanwhile, Berkshire uses those growing dividends to invest in other things, creating a never-ending wealth-building machine. Most brokerages like Fidelity, Schwab, and Vanguard offer DRIP programs, dividend reinvestment plans, that let you automatically reinvest your dividends into more shares, with no fees and no effort. Just flip a setting and it runs on its own. Some investors prefer to reinvest manually so they can choose where to put the cash based on current value, which gives more control and helps keep their portfolio balanced. Just remember the tax rules. In regular taxable accounts, you still owe taxes on dividends, even when you reinvest them. But in Roth IRAs or traditional IRAs, reinvestment is either tax-free or tax-deferred. If you're over 50, you can contribute an extra $1,000 each year to these accounts. One of my clients, Paul from Michigan, put $10,000 into 4 dividend stocks 8 years ago and set up automatic reinvestment. Today, that investment is worth $18,000, and his yearly dividend income grew from just $30 to over $700, all without adding another dollar. That's a 130% increase in income. The key is to never sell your dividend-growing companies and let the compounding keep working. Buffett held Coca-Cola shares for 35 years without selling, showing that the longer you hold quality companies, the stronger your wealth snowball grows. Now let's talk about scaling from a few $1,000s to hundreds of thousands in dividend income. Reaching $200,000 a year in dividends may sound huge, but it's actually doable if you follow a smart plan and focus on steady growth. Most people think they need risky bets, but Buffett's method is about hitting small wins and letting compounding do the hard work. There are two practical paths to get there. The first is based on time and patience. Start with $5,000 in good dividend stocks paying 3% and growing dividends by 7% yearly. In 30 years, you could earn $40,000 to $65,000 per year, and your portfolio might be worth $200,000 to $250,000. Impressive, but it won't hit the $200,000 annual income goal unless you wait 40 to 50 years, which most people over 50 can't do. The second path is more realistic. Start with the same $5,000, but invest an extra $1,000 every month for 20 to 25 years. That could come from downsizing, part-time work, or redirecting savings. With the same 3% yield and 7% growth, your portfolio could grow to $1.50 to $2.50 million, giving you $150,000 to $200,000 in yearly dividends. And thanks to continued growth, you'll break the $200,000 mark soon after. $1,000 monthly might sound tough, but over 25 years, it adds up slowly. You don't have to start there. Begin with $300 a month and increase as your income rises or expenses drop. If you start at age 50, year 1 with a $5,000 start and $300 monthly adds up to $9,000 and gives you $270 in dividends. By year 5, you'll have invested $40,000 and be earning over $1,000 per year. By year 10, you might have invested $90,000 and be earning $3,000 to $4,000 per year in dividends as growth picks up. By year 15, your portfolio could grow to $160,000 and bring in $6,000 to $8,000 annually. And this doesn't even include lump sum additions like inheritance, property sales, or 401k rollovers. Any of those can speed things up even more. Buffett teaches that building wealth isn't about finding the next Amazon, it's about steady investing in quality companies, reinvesting your income, and giving time a chance to work for you. Most people don't realize how powerful slow, steady investing becomes over 20 years. Even if you only reach $50,000 to $100,000 a year in dividend income, that can totally change your retirement. You won't have to rely only on Social Security or your 401k. Now here's the fifth key point: protect yourself from commonwealth destroyers. These are mistakes that can undo years of progress, especially after age 50. The biggest one is chasing high yields out of desperation. This usually happens when someone feels behind in their savings and tries to make up for lost time by investing in stocks that pay 8 to 12% yields. But those high yields usually come from companies whose stock prices dropped due to poor performance. Mike from Chicago did just that, buying REITs and energy partnerships with high yields thinking he found a shortcut. But when those companies cut dividends during a market downturn, his income dropped 40% overnight. The lesson? A safe 4% dividend beats an unstable 10% every single time. The second major mistake is buying businesses you don't understand. This often happens when people invest in complicated financial products, overseas companies, or trendy industries they don't really get. Buffett's golden rule is simple: never invest in something you can't easily explain. If you can't describe what the company does in plain language, you shouldn't own it. The third trap is not understanding taxes, which can be a big issue for dividend investors. In taxable accounts, you have to pay taxes on dividends every year, even if you reinvest them. For people with higher incomes, total federal and state taxes on dividends can be more than 20%, which seriously slows down your compounding. That's why it's smart to focus your dividend investments in tax-advantaged accounts. Roth IRAs are especially useful because qualified withdrawals during retirement are tax-free. Traditional IRAs also help by letting your dividends grow without yearly taxes, though you'll pay taxes when you withdraw later. The fourth mistake is ignoring signs that a company's dividend might be at risk. Just because a company has paid dividends for years doesn't mean they'll keep doing it. General Electric and Kraft Heinz both cut theirs significantly, and several oil companies paused payments in 2020. You need to keep an eye on your investments. Make sure the company's dividends are supported by earnings. If they're paying out more than they earn, it's a red flag and likely not sustainable. Watch out for signs like falling revenue or rising debt. These can mean trouble ahead. Tools like Simply Safe Dividends can help by giving you clear safety scores for your stocks. Don't get emotionally attached to any company. If its financial health gets worse, be ready to sell. Another big mistake is spreading your money too thin too early. Buying too many different stocks when you're just starting out can hurt your returns and make it harder to track everything. Buffett says if you really know what you're doing, focusing on a few strong companies is better than trying to own everything. Start with 3 to 5 solid dividend-paying companies that you truly understand. Only add more when your portfolio grows and you can handle it. Don't feel like you must own 30 stocks just because some advisor said so. The best dividend investors check their stocks just twice a year, asking, is the company still raising dividends? Are its financials still strong? Would I still feel good owning it for the next 10 years? If the answer to any of these is no, they sell and invest in something better. Have you made any of these mistakes? Share in the comments, your experience could help others. Now, let's put all of this together into a solid plan, your personal dividend freedom blueprint. This is a step-by-step strategy for building lasting income, so you're not left guessing. The most successful investors, like Buffett, follow clear written plans. They don't wake up unsure of what to do, they stick to a strategy that removes emotion from the process. Begin by setting a clear income goal. Don't just say, I want more money. Be specific about how much income you want your dividends to produce. Be very clear about your goals. For example, aim to earn $3,000 a month in dividends by age 65 to help with Social Security, or enough to cover property taxes and healthcare costs by 70. Write down your exact target and when you want to reach it. Next, pick your main dividend growth companies. Choose 3 to 5 businesses you understand and trust to hold for 20 years. Use these rules: at least 10 years of dividend growth, reasonable payout ratios, strong free cash flow, and strong competitive advantages that last. For example, you might pick Coca-Cola or PepsiCo for consumer staples with steady demand, Johnson & Johnson or Pfizer for healthcare, Chevron for energy, since Buffett likes it, Microsoft or Apple for technology with big cash flow, and JP Morgan Chase or Berkshire Hathaway for finance with strong leadership. Only choose companies whose business you can explain in 1 minute. If you don't understand how they make money, don't invest in them. Then, decide how much money you'll add each month. Even $250 a month helps more than starting big and stopping. You can get this money by paying off low-interest debt faster, working small side jobs, or cutting some expenses. Where the money comes from is less important than sticking to your plan. Next, pick how to handle dividends. Either use automatic dividend reinvestment plans, DRIPs, that buy more shares for you, or collect dividends as cash and manually invest in the best opportunities every few months. Both work, but choose one method and keep it. Set a schedule to check your investments twice a year, maybe January and July. Make sure each company is still growing dividends and in good financial shape. Don't panic or change plans because of short-term market ups and downs. Finally, set your freedom trigger, the monthly dividend income that will let you make big life choices, like working less or traveling more. For example, $2,000 a month might allow fewer work hours, or $36,000 a year could fund a fun lifestyle. Setting clear goals makes every month of investing meaningful. For example, my goal is to earn $4,000 a month in dividend income by age 67. I'll invest $750 monthly into 5 companies, 20% each in Coca-Cola, Johnson & Johnson, Microsoft, JP Morgan Chase, and Chevron, and automatically reinvest all dividends until I reach my income goal, then switch to taking dividends as cash. I'll review my investments every January and July, selling any company that cuts dividends or weakens financially. When I reach $3,000 a month in dividends, I'll move to part-time work. Having a written plan takes the guesswork out of investing. you won't constantly worry about what to buy or sell. Stick to your plan no matter what the market or news says. This isn't about getting rich fast or beating the market yearly, it's about building steady income that grows faster than inflation and leads to financial freedom. Warren Buffett didn't get rich by trading often, he bought great companies and held them for decades while they paid growing dividends. Your dividend freedom plan is your roadmap to building wealth the same way. Start with what you can afford and stay consistent, letting compounding do the heavy work. Building dividend income after 50 isn't about chasing hot stocks or timing the market perfectly, it's about following the proven path that made Buffett one of the richest people ever, owning quality businesses that pay you regularly and growing your income over time. Every day, companies like Coca-Cola, Johnson & Johnson, and Microsoft generate profits and pay shareholders. Pick companies with strong advantages that raise their dividends yearly. The choice is yours. Keep hoping your 401k and Social Security will be enough, or take control by building your own dividend income stream. Forget chasing quick return fads and focus on this time-tested method that's made more millionaires than any other. This math is real, based on decades of actual company performance. Consistent investing, reinvesting dividends, and smart company choices lead to amazing growth. Even starting with $5,000 can turn into life-changing income, but you have to start now. Time is your most powerful tool, and you can't buy more of it. Every month you delay dividend growth, you lose forever. So, your next step is simple. Choose one reliable dividend growth company you understand and can afford. Buy your first shares and set up automatic dividend reinvestment. Keep adding to your investment every month, no matter what the market or news says. Men who achieve real dividend freedom start right away, not later. They follow a clear plan instead of reacting to emotions. They think like business owners, not stock traders. This strategy has helped generations of successful investors build wealth. It's working for Warren Buffett today, and with patience and discipline, it can work for you too. If you found this video useful, be sure to like, subscribe and turn on notifications to not miss our future uploads. See you in the next video.